Welcome, and today we are going to talk about the best practices, and this meeting is going to focus on some changes that the committee made to the best practices, and we're going to review those and get a little bit into some of the why and the what. So just as a recap for today's agenda, I'm going to start by grounding us in why we do this work, talk a little bit about who is partnering on us with this work. And then we will talk a little bit about why we have made some changes and then dig a little deeper into those. And then we will definitely have time for questions and conversation. And I welcome people's thoughts and inputs in terms of how they think these changes could positively or negatively impact DPA. So I'm going to go ahead and sorry, we've got quite a few people in the waiting room, so let me just let them get in. All right, so a little bit of grounding in terms of why we have the best practices. So these best practices were established a few years ago by a subcommittee of subject matter experts who essentially said, how can we make how can we make down payment assistance more accessible, transparent, and create more access to buyers? And one of the things that we thought about and decided to move forward with was essentially establishing best practices for the product terms for down payment assistance. So in addition to that, we have had some efforts around making sure that funds that are available are targeted in reaching those with the greatest need and those that are in community that have been intentionally left out of homeownership. And we've started to try to create a conversation and a collaboration amongst DPA providers in the metro and across the state to really learn from each other and support each other and start to unify and streamline the approach that we take. So we do have a subcommittee that focuses just on this, and I wanted to share the members of that committee with you to just reinforce that we really are doing this in partnership with industry and really trying to pull subject matter experts in across the board, from nonprofit lenders to homebuyer educators to cities, to banks, lenders, and realtors. So really kind of a good collection of people who bring differing perspectives of the industry and how down payment impacts the work that they do. So a little bit about why revisiting the best practices. So it's been a little over 2 years since we launched these best practices. We have learned a lot and we've had more experience with larger scale down payment assistance programs that have allowed us to learn and better understand ways in which we can achieve the goals of transparency, access, and ensuring those that we're reaching with the greatest need. So this is obviously an opportunity for continuous learning. These best practices are not stagnant, and as things change both in the industry and our economy and the market, we're going to continue to pay attention to what's working and what might we need to look differently at. An example I like to share is that right when we were starting with the best practices, the interest rates were very, very low. And then we had a pretty steep change. And one of the things that we learned is that because interest rates had been low for quite some time, a lot of DPA providers had gone away from allowing resubordination. And so without really realizing it, they were locking buyers into high interest rates. Now, granted, those interest rates have remained pretty steady, but we've worked really hard to share the opportunity for DPA programs to allow resubordination for interest rate, even though it does mean more work on the DPA originator. But really making sure that, especially for deferred longer term programs, that we're not locking people into interest rates. So that's just an example of how the market can influence what's important in these product terms and how it's important for us to work together and collaboratively help make, again, these best practice or these down payment programs more accessible. Um, Another reason why we are looking at the best practices, as you know, affordability continues to be a barrier, and we're seeing that what we would have considered moderate income buyers being locked out of homeownership. Also, there's an unprecedented demand for DPA, and while we have had some large investment, those investments are scaling down, and we're seeing less investment in some ways in DPA from other organizations that have historically provided DPA. And so it as DPA has become available and it's kind of ebbed and flowed a little bit, we have seen the highest level probably ever of demand and need for down payment assistance. So we felt that that really prompted us taking a look at these. And then again, as I continue to say, really making sure and measuring if we're meeting those with the greatest need with these best practices. So before we get into the details, here's some of the things that we kind of dug into. We really went through each best practice. We spent a few months and several meetings talking about these and going back and forth, again, bringing all perspectives to the table from the industry. And we really leaned into the amount of assistance, income limits, looking at lender qualified income as a way to determine eligibility for down payment assistance, the value of instructor-led homebuyer education, and some new limits, again, aimed at reaching those with the greatest need. So I'm going to kind of dig into each of those. So, starting with increasing the amount of assistance, when we first launched the program, we recommended that DPA administrators, when they're setting their product terms, used about 3% at least of the county median home price to determine kind of an impactful amount of down payment assistance. And there was a lot of debate on this because we understand that resources are limited and we want to be able to touch as many buyers as possible. But again, the affordability barriers are getting more significant. So we're encouraging those who have the opportunity to consider actually increasing their investment. And then for targeted programs, which are generally reaching those who do not have access to generational wealth, looking at an even higher amount of down payment assistance to help account for the lack of wealth and resources to contribute to their first purchase of a home. So again, this why it matters. The home prices are continuing to increase, rising costs with interest rates. We want to make sure that we're providing a more meaningful amount of assistance and helping buyers get into a home both in a tight market and in a way that is sustainable and affordable. So higher income limits. So we essentially left the kind of your standard first-time home buyer DPA program at 100% AMI, but we are encouraging for targeted programs, again, like first gen or special purpose credit programs that are really aimed at reaching those who have been left out of homeownership, that they consider a higher AMI of 115%. Obviously, all of these product terms only work if your funding source allows you to make these changes. But when you have that flexibility, providing the opportunity to go higher income, I think is impactful. Again, we're seeing a lot of moderate income buyers being locked out of the market. And I think AMI has become a moving target and not it doesn't represent what it once represented in our current economy and housing costs of our market. And I think what we're actually starting to see a transition to of this conversation in homeownership and down payment assistance, which has been heavily focused on first-time buyer and low to moderate income, is actually what is the conversation about measuring instead of low to moderate income, really what it means to have low wealth, and that down payment assistance really can be the game changer for those who have low wealth due to a lot of various factors, but particularly for communities that have been left out of homeownership and haven't had the opportunity to pass that generational wealth on. So again, for targeted programs, like so if you offer a first gen program or are considering it, or if you're offering other target programs that are census tract trying to reach communities of color, that you would consider a higher AMI to kind of address these issues of inequity, lack of generational wealth, and that income alone does not reflect the ability to access housing. So next, we're going to talk about lender qualified income. This is always I don't know, controversial is the right topic, but this one is debated quite often. And lender qualified income is essentially what we are recommending is that if you have a funding source that allows you to do it, that rather than having a separate eligibility for household eligibility around income, meaning doing household income, having your own set of criteria, counting everyone who lives in the home, kind of our standard, what we have done historically through federal funding that has its own origin and roots that are based in a lot of things that are not related to need. Um, that you look at doing lender qualified income. This really allows you to align with the first mortgage provider. It also makes the process a little bit more efficient and accessible. It adds a lot of less confusion and it really streamlines the process. And one of the concerns is hidden income. And so that, you know, the potential that lenders might not include income in order to make them eligible for the down payment programs. So one of the things that we're recommending is that in the cases where you allow lender qualified income, because your funding source permits it, that you then have a form that essentially the lender would need to disclose any excluded income and reason for exclusion. And then you as a DPA provider could make some decisions about what you think is allowable. But Jason popped on because I asked him to kind of speak to this a little bit. Because as a DPA administrator of a variety of DPAs originating on behalf of different municipalities and programs, Jason has seen kind of both sides of this, using household income and using lender qualified income. So I'm going to let you just share kind of some of your experience, Jason.
Yeah, thanks, Brooke. Jason Peterson with NeighborWorks Home Partners. As Brooke mentioned, we administer a number of different down payment programs utilizing a variety of sources based out of the Twin Cities, but do down payments statewide. As Brooke mentioned, historically, down payment, especially, I mean, really, we're talking about here, any kind of government funded down payment or primarily any kind of community funded down payment. This isn't really going to be kind of portfolio bank product. It's going to look at that household income. And, one of the things that we saw, because almost all the programs that we administered for years and years focused on that household income piece. Brooke kind of alluded to this, but I mean, you're required in that case to look at everybody's income in the household, whether they're contributing to the mortgage payment, whether contributing to household expenses. So this could be the income of, say, an elderly parent or a child living there that has a side job. And while you did adjust for household size, this did really skew towards helping single individuals and really penalized isn't the right word, but really hit hardest against larger multi-generational families. Um, and how we've really seen this play out is a lot of it just makes for a really challenging process all around. So you'll have a first mortgage lender that will determine income, and they'll say this is the income you likely qualify for this. And then they'll refer to a down payment program. And then when the down payment program receives that application, we need to then get all, if the down payment provider is going to be doing household income, we not only need to collect all the income documentation that that first mortgage lender has already collected from that borrower, but then any additional information to make sure we can collect all that household income data. So you're basically doubling or duplicating that work to get to a number that you're trying to determine if they qualify. So not only has that first mortgage lender already done a lot of that work, then that down payment provider is duplicating that work. And more often than not, that number does not align with that with what that first mortgage lender thinks that number should be. So then there's confusion from that first mortgage lender and all other parties in that transaction. But most importantly, for that borrower, they're just not sure. You know, they're not sure, do I qualify? What is that next step for that? And so, you know, the challenges are not only that duplication in that work, but also just that uncertainty. So, you know, why it matters, why it's important. So it improves alignment with the loan underwriting practices. So you have standard first mortgage lender practices, and it just makes that process easy. Everybody understands this is the income that we're looking at. As Brooke mentioned, there are going to be cases where the first mortgage lender is excluding income for a variety of reasons. And the intention of using lender qualified income is to not allow, I mean, the whole idea is we're not trying to suggest this to allow folks that may not meet the income requirements to sneak under that. So the idea is all that any additional income is counted, but the idea is what is being counted by that first mortgage lender is what you're going to use in that process. It makes it so much easier and it removes that confusion and that frustration. And then to the next one, it streamlines that process. It allows that first mortgage lender to know with a very high probability if somebody's going to be eligible or not. The number of calls that we get about, hey, is this person going to be eligible? They have these people in their family. And the answer is usually we don't know because we're going to have to look at this. And then it certainly does occur where we think somebody's eligible. And once we look at, say, their elderly parents' income, then all of a sudden they're not eligible. So the other thing that I would mention regarding the streamline and efficiency is it just speeds up that process. So you get that lender qualified income. And a great example of this is the current community-based first generation down payment program. So that's the primary widespread program now that allows for lender qualified income. When an application comes in with a fully underwritten pre-approval, that first mortgage lender has fully underwritten and provided that qualifying income, we know what that income is going to be. And so we're not sitting there calculating it, tracking down documents. It can just speed up that entire process. Um, it also avoids disqualifying households based on non-borrower income. So that's what I mentioned earlier. This primarily hits larger families, multi-generational families. And then lastly, it's just that consistency and transparency. So again, it benefits folks. If, you know, first generation, again, I'll use that as the example, there are income limits that are posted. And when the lender does the qualified income and uses all the income, they will pretty much know whether or not they're going to qualify or not. So there's no second guessing. There's no confusion. And it just cuts down on the work for all. So it allows the down payment providers to be more efficient, to be more expedient, and it allows more certainty for the transaction. So the caveat that Brooke mentioned early on is it depends on funding source. Certain things like CDBG, CDFI require this, but it is a benefit to everybody within the transaction if it is allowable to use lender qualified income.
Thanks, Jason. I appreciate you sharing that experience. And we did have a question in the chat, just kind of around what do you do when you say, you know, disclose any income that was not included in the reason, including for like, what if there's a non-purchasing spouse? So I think you as program administrators, those that are kind of setting the rules for the DPA can very clearly say like, not allowed. And I think what you're going to see more commonly is you're going to see that first mortgage lenders are actually more conservative. And so they have to resell these products on the secondary market. And when they keep them in-house, they're not looking for loans to go bad. So usually where you're going to see the discrepancy is like Jason said, non-borrower income. So they're only going to make sure that the people who are paying the mortgage are actually being included. So if you've got the 25-year-old who landed back at home, or you've got the elderly parent, or you've got a sister living with you temporarily, or the multi-generational thing who may not be contributing to the household expenses. But really, what you are often going to see is going to be things like side gigs, overtime, and first mortgage lenders have conservative measures on that because they don't want people to take out more than they can afford, and they want to ensure that those loans are going to make it and that they can sell them, and they have guidelines. So really what you're going to see is it more accurately reflects what is considered allowable on the secondary market than it is people trying to hide income and hustle income. And then having this worksheet and this disclosure just is kind of your way of covering that a lender essentially has to say that they didn't exclude income, and if they did, for what reason. And it will be, again, things like side jobs, overtime. I think some products require like 18 months of history on overtime. And if you're doing a household income and you're just looking at taxes, or you're looking at year to date, it's not reflecting the full underwriting that's happening with the first mortgage. And then I think that, you could receive this income or receive this information prior to approving them for the DPA. And, you could clearly state like things like non not including spouses or leaving out income to, for certain reasons is not allowable. And you, as the DPA administrator setting the terms, can address those things. Jason, is there anything that you would add to that before I move on?
No, I think that's a great answer.
Yeah. And honestly, people these houses are expensive, and people need both incomes. They need all the income that they can apply in this current market to be able to get into these homes. So again, we find it to be a very small percentage of people that are using it to squeak in under eligibility. So, um, next one is instructor-led education. So this is a change based on just experience of what we have learned with the first generation statewide community fund. And so essentially, the change is that we are encouraging that you require instructor-led education, which means it can be in person or virtual. So, for example, and the two courses that we're recommending that are allowable is Homestretch and Realizing the American Dreams. Both of those are courses that were developed by HUD Housing Counseling intermediaries and used by organizations that must meet standards in order to deliver them. So these are the two courses that we're recommending. And then if you do allow a self-guided course, we're encouraging you to require one-to-one homebuyer education. So, we're at a volume that we haven't quite seen in a long time for a down payment program. The community fund is at, I think, nearly a thousand new home buyers, plus all of the numbers of people who are in the pipeline. So we have a lot of data that we're looking at. Um, and one of the things that we're seeing is that a high percentage of people are completing framework. So they're doing it prior to the purchase agreement because that's the requirement. But they're taking online education. And if you are an organization like Jason or others that promote and allow the use of framework, like on your website, you see the back end. So we have back end data that shows that most people are spending less than an hour in the framework course. And then what we're hearing from industry partners is that not always is it the borrower completing the course, and in some instances, people who should not be completing it on their behalf are. And so there's a lot of concern around people not really getting the engagement and the knowledge that they need. There's a lot of benefits with homebuyer education in terms of them being equipped and prepared. And to be honest, it's just the demand for people who have been doing framework and then requiring the one-on-one has been high. So, as you're thinking about this, with the change of COVID and how we engage, online, virtual, instructor-led courses have come a long way. Homestretch has come a long way, and it's accessible because people can take it virtually. The difference is that they're engaged in a class rather than sitting and doing a self-guided course and click, click, click. So strongly encouraging you to consider making this change, and so that people are really getting what they need out of homebuyer education. And really, again, the benefits of education in terms of preservation and understanding kind of what people are getting themselves into. So while we do have the self-guided course option here, again, we would ask that you also have them complete a one-to-one counseling session, but just know that the benefit is greater if they do the workshop. And in the workshops, the one-to-one counseling is always promoted. So if anyone wants to have that individual, they always can. But a lot of people get out of that workshop what they would do if they did the online and then met with the homeownership advisor. So let's see here, moving forward. So this is really about kind of like getting at making sure we're reaching those with the greatest need. So purchase price and ratio guidelines. So we are encouraging people to set maximum purchase prices if they do not already, using recognized benchmarks such as Minnesota Housing Startup, home limits, FHA limits. Again, really trying to target who really needs this program. We actually added purchase price limits to the First Gen Community Fund after we launched because we saw really high purchase prices coming in and it wasn't something that we anticipated. So again, to ensure we're reaching those with the greatest need, we added those things. Also kind of getting at this was housing ratio. So both in terms of making sure that people are there that 25% essentially of their income is going towards housing, right? So that they are contributing the amount that they can. And then two, that we're also not overextending borrowers by going too high on the DTI. And as many of you know, FHA does allow up to 55%. And with the high housing costs, we're seeing a lot of people getting pushed into margins that have historically shown a higher rate of exiting homeownership and risk to preservation. So Jamie just popped on and he's going to talk a little bit about what they do in Woodbury with purchase prices.
Yep. Thank you, Brooke. I'm Jamie Fritz with the City of Woodbury. Um, so the City of Woodbury has an HRA, and one of the HRA's primary programs is its down payment assistance program for first time and first generation buyers. So purchase price. So the Woodbury HRA decided to index its purchase price based on the Washington County Assessor's Report that's released each year. And the decision was to index our limit on 100% of the median home price in the city of Woodbury. That was established, I think, maybe 8 years ago is when we decided on 100%. I think before that, it was a little bit higher at 120%. But the core reason that we went with as local as an option as we can get, which is pretty much just focusing on what is the median price in Woodbury, we looked at what CDBG or some other programs would allow you to do, which would be looking at the metro area median home sale price. But after discussing with council and I think our local HRA at the time with the county, we thought it was best to pick something that really represented the market within Woodbury and to pick the most local option that we could find and still allow for, because every city is different, especially here in Washington County. There's a lot of rural cities. There's a lot of, and we're more of the urban city, us in Oakdale probably. So there's a lot of variation in the amount of house you could buy in different cities throughout the metro area based on what the price is. So we've been pretty satisfied with how we picked to do it at that really local level. I think our average purchase price last year was just over $300,000. Most of our borrowers tend to go for the many townhomes that we have here in Woodbury. which tend to be between, 300, 375,000. We very rarely have gotten up to the maximum purchase price. I think very few people actually have made it up to what it was before. I believe it was like 446 last year. And this year we're increasing it to 451. So we've, feel like it's been pretty appropriate. It's not too much, it's not too little. People are able to find homes within, that price range or below. So I think when you're thinking about how to set it, I think it would just be, are you targeting certain areas of your city? Are you a bigger geographic footprint, like a county or tri-city area? And if you're just a city, it might be best just to look at, what makes sense locally for you and what, and that population you're trying to serve too. Like, is that purchase price going to meet their needs for bedroom size and all those things to consider?
Thanks. Appreciate that, sharing your experience. And I think particularly too, if you're city or county that you're offering, or if you go broader than that, like, do these indexes mirror your city, or are you a higher price city, like maybe like a Woodbury or an Edina or some of these other counties, right, where you have maybe higher home prices, and then other communities you have lower median home prices. So it really does reflect kind of the community, and isn't just kind of a one size fits all. But looking at maximum purchase prices, especially too, like this is a balanced approach, right? So if we're using lender qualified income, if we're considering people 100% AMI or 115% AMI, we also want to balance and make sure that we're reaching those within that kind of bucket of households that actually are low wealth and have the higher needs, and that people don't just happen to meet eligibility in terms of being a first-time home buyer or first-generation buyer, but actually demonstrate need for the program. And so having kind of those maximum purchase price that reflect your target audience or reflect the community you're making the product available is going to be another way that you're going to kind of put bumpers on in terms of reaching those with the greatest need. So our last slide on this is focused on asset and gift contribution. So we did not, when we launched the best practices, have an asset limit, and we discussed it at length, but we did decide in this current market that it makes a lot of sense to encourage having asset limits post-closing. Again, this kind of came out of some experience that we were seeing with programs around people post-closing having a large amount of liquid assets available to them. So obviously, this does not include retirement, 401, 403, 529 plans. This is really about liquid assets on hand, and working with the first mortgage lender around um, uh, knowing what this amount is probably going to be the easiest way to manage this, rather than you collecting all of the documents and verifying. The reality is, if people want to hide assets, they certainly can. But again, this is about, ensuring that if people are purchasing a home and they can contribute to that home purchase and maybe don't need the DPA, that we're identifying that. And $50,000 probably feels like a really high number. But again, we also want people to be set up for success and have access to liquid assets. And if they have had the opportunity to build savings, we don't want to deplete that, but we do want to make sure that there's a balanced approach. The other limit is gift contributions, which is not something I don't think we had ever talked about as a subcommittee, or really much conversation that I had heard of in this space. But with the First Gen Community Fund, we did see a large number of transactions starting to come through with pretty significant gift investments. And again, we want people to utilize their resources. We want people to be able to get into home ownership that's affordable. put down 10%, 20% of the purchase price, particularly with the affordability gap issue and having to make up and contribute more in the transaction to be able to qualify for the loan and to afford the payment. Understanding all of that, and acknowledging that if you can receive gifts of greater than 10%, you may not need a down payment program. You may just need the gift to access the home. So putting this limit here, and then again, the first mortgage lender really is your source of information on this in the sense that they can provide you the gift amounts and the information, really the gift letters, so that you can make sure as a DPA program that this is being met. So if you're setting the product terms, having this limit, and then the entity that's administering it, if you're not administering it on your own, would then obviously have to work with the first mortgage provider to get documentation of this. And all of this would be in your product terms and clearly disclosed ahead of time. So again, it's a balanced approach. We don't want people to use all of their liquid assets. Of course, we want people to get support from community. Of course, we want people to help make up the affordability gap issues so that they can get into home ownership. And we want to make sure that we have equitable distribution of very limited resources, and that we're reaching, again, those with the greatest need. So I would love to open it up for feedback. I'd love to hear from people in terms of what changes do you think will have the greatest impact, if you think they're positive or negative, or if you've had any experience with any of these things that we are suggesting that you've seen lately in your administration or deployment of DPA.
Hello, this is Erin. I guess my only comment is I really wish that it would be considered to reduce that minimum housing debt ratio. Just because people with more wealth, their housing debt ratios are usually like 10% or 15%. And it just seems wrong that, lower to moderate income households are so heavily burdened with house payments. And we saw the lower ratios with First Gen and some of the other programs. So I would just really wish Minnesota Housing and everybody would reconsider that 25% minimum.
Yeah, I think that's fair. I think First Gen right now is 20%, so it's a little bit lower. So I think that's fair, and I think there was a lot of conversation back and forth on this for sure. Melissa Hanson.
Thanks. For somebody who primarily administers the CDBG part of the down payment assistance, did I hear you correct in saying that I still have to collect income even though the first mortgage has underwriter has already done that? I can't streamline this at all?
Our CDBG friends and family, can you share?
I can. Yeah. So, hi, I'm Ryan, City of Minneapolis here. Jason, obviously, you can chime in too. Our program's funded with CDBG, and we have to follow HUD Part 5. So essentially, it's something you have to follow. You have to use CDBG's requirement for income, not lender. That's how we approach it. Jason, I guess you're more well versed than I am, obviously. So.
No, you're right, Ryan. So unfortunately, you don't have that option. And so I think there's two things that are kind of come from that. One is not only can you not just use the borrower income, but you also have to use household income. So CDBG requires that the down payment administrator independently look at income, and then you have to look at household income. So CDBG right now does not give you that choice. That's correct.
And what I'm sorry, I'll just add, and then Erin, I'll let you go on.
Go ahead.
Melissa, what we're seeing is when possible, cities are really looking at different ways to fund DPA. So whether that's through the LAHA dollars or it's through a referendum or their HRA, they're really trying to find, is there buckets of money that we can move? And is there a way that CDGB can support other things that it's better aligned with? And is there other resources for DPA? So we've seen a lot of that over the years. And obviously it's a longer term strategy. But yeah, CDBG has been difficult at times to use, considering how much DPA has evolved and how the need has changed. Erin, did you have something that you wanted to add?
Yeah, I was just going to mention I do have quite a bit of experience with CDBG and home, and those guidelines with household income have been in place since 2004, and I think it would be like having HUD change those rules, and it's grueling. I mean, I struggle to this day with those income determinations, so I just wanted to chime in on that.
Yeah, I appreciate that perspective, and I think what we're trying to do is like have people just think, right? Like so, like if you've only we just because CDBG kind of was the standard for a long time for DPA and the only source for a long time DPA, some people are launching programs with new funds and just repeating the practice. And so I think what we're trying to say is that if you have a source of funds that allows flexibility, reconsider that. And I think to your point, Erin, they haven't been updated for over 20 years. And prior to that, it was probably 1980. And it's dated in a philosophy and in a belief that doesn't necessarily align with the way homeownership is working right now. And I think if it's good enough for the secondary market, I think we have to think about what can work for DPA. Other things that you think will have the greatest impact, positive or challenging, or scenarios that you've encountered where you've seen some of these things lately?
I can speak to the instructor-led homebuyer education. So we annually work with about 1,300 families, and last year I think we closed about 300 down payment loans. And the number of people that we're working with towards the end of the process that still don't understand some of the basics of the process, it's clear that the non-instructor led education has not provided the foundation of knowledge that would be necessary. So I really appreciate the participant led education in that it has a lot of flexibility, and there are folks that really have a lot of time constraints, so that works really well. But I would just echo what Brooke said. There are a lot of great homebuyer education providers, many of which are offering virtual instructor led with various times and days. And even a virtual, you're at home or you're not in a classroom with others, but you have that opportunity to engage and ask questions. Um, and it is for sure the borrower, and it is, for sure going through these topics. And so there's a time and a place for that, that participant led, but from what we've seen, we don't often get some of the very simplistic questions from the folks that have gone to the instructor-led homebuyer ed. And still, over the last decade and a half when I've been with the organization, the most common response that we get on our home buyer education survey when, what would you like us to know? I wish I would have done this earlier. And so there's just so much education and knowledge in there. And I mean, I'm not saying framework's bad, but I would echo what the recommendation is instructor led is really powerful. And if somebody does framework, the opportunity to do an in-person, to ask follow questions or make sure you're understanding, an in-person might just take an hour. But at our organization, we have evening appointments, daytime appointments, virtual appointments, and there's many providers across the Home Ownership Advisors Network that have a lot of flexibility and a lot of different language skills and different expertise and experiences that can really make sure. I mean, as we all know, buying a house is a huge decision. Folks really need to understand that up front, and framework doesn't always do that for everybody.
Thanks for that, Jason, and just the experience of what you're seeing, because we're doing a very high volume of DPA in our market right now, and I think it's giving us an opportunity to really learn a lot. Melody, I saw you came off mute. Did you have something you wanted to add?
Yeah, so we just out here in Garber County just launched DPA using your best practices. So thank you all for the support and work that you've done. We have gotten some pushback because we are requiring a mortgage underwritten pre-approval process. The lenders aren't necessarily familiar and are definitely not happy with that piece. Is there a little bit more you can provide to me and us that are doing this as the rationale for why that is required?
Yeah, so the underwritten pre-approval is something that we did with First Gen and something we have done with another community program that we're offering. And the logic and the rationale is this. If we're using lender qualified income, we need to know that you've actually looked at their income, debt, and have for sure done that. And that if we're like, I'm assuming, Melody, the trade-off is that you're reserving funds for those buyers while they're shopping. So we're actually holding these funds. So we need to make sure that the buyer is actually qualified for a mortgage and the income has actually been looked at and they actually meet the income qualifications. And unfortunately, in the first mortgage side, there isn't a standard for pre-approval. It ranges greatly by lender. It ranges even sometimes by individual loan officer. And so until there's a standard, that's the only way for us to know for sure that it's actually being done in a standardized way. And I think that if buyers are getting a significant investment in DPA, we're streamlining with qualified income, and we're reserving the funds while they shop, we're asking first mortgage lenders to be a partner in this process because we're helping their consumer close the deal in a transaction for them as well. So I think I would just say stay tough on that and note that those are the trade-offs and the benefits to the consumer.
Thanks.
Emily, I think did you have your hand up, Emily?
Yeah, I'm one of those lenders who complained about the underwriting pre-approval.
Yes.
So we had to scramble pretty quickly when MMCDC First Gen came out to create that process because that's not something we do at Bell Bank. And so that was rough, but we did it, and we were very happy. Totally understand the perspective that you're giving is you want borrowers to be shopping knowing that they can actually secure those funds because you're right, that's a huge issue. People kind of going shopping with sort of thinking they can get that money and then it's not there anymore. That is a problem. I would pose a suggestion. I think it would be a cool idea if there was some sort of lender certification. I've seen some success with programs in Florida where they do an individual LO certification where they train them on, what is required so that sort of the caliber of the loan officers that are offering those programs. And then you can sort of point to those loan officers as individuals who truly are experts in that field. Because we know if you ask a lender, everybody does DPA and everybody's done one last month. That's not true. We know that. But if you're really trying to find a way to make sure that borrowers are working with individuals who actually know how to, say, calculate income or the program guidelines, I would argue that a lender certification would be better. I think that would be more work for the administrator and less work for the loan officers. Maybe it might be equal for both, but I think that's another alternative. What's happening, at least what I'm seeing with some of the DPA programs, at least in the Twin Cities, is that as this requirements gets added, it's holding up transactions because borrowers are like, oh, you can't do that yet for me. We have to scramble to kind of figure out an internal process because we offer the nuances between a full pre-approval and a pre-qualification are minute, but they have HMDA implications, which is sort of the red flag for all lenders. And so it's created some barriers for lenders like ours, Bell Bank, and several others. So that's all.
Yeah, I appreciate that perspective. And, I think this idea of almost like a lender approved kind of list or loan officer approved list. And, there's pros and cons to that too. And we've had a lot of conversation about that. And I think we have to continue to evolve on this one, and I can see this continuing to change and grow, and as we learn together in the best way to do it. And 100% understand that it is a lift, and there are a couple lenders that just simply said no, we're not going to do it for business purposes and practices. And so it's just this balance of like it's DPA is a lot of work on both sides, and however we can help the buyer be successful. And Emily, to your point, I think as we continue to grow in this field, we have to think about what is the middle ground and how might we be able to look at something like a loan officer approval. All right. Other comments or things that you are seeing and experiencing, or some of these changes that you think may have a positive or negative impact? Okay, well, I appreciate everyone's participation today and conversation. These updates are actually already on the Homeownership Center's website under partner resources. The best practices are listed there. These updates are included. You can download it as a PDF. It's also on the webpage. We also have all of the webinars that we've ever hosted are recorded. And so if you are looking for resources, I would say check it out there. We have topics all the way from talking about lender qualified income to homebuyer education prior to pre-purchase, to just a variety of topics that are resources to you. And if you are in the process of making changes to programs or launching a DPA program, I am a great contact, and I have the support of the subcommittee, the DPA Best Practice Subcommittee, that can also help offer some guidance to you. So I appreciate everyone's participation today. We are doing these basically quarterly. So the next time we'll come together will be August 7th, and to be determined on topic. We might focus on maybe some of our learnings from first gen. We're going to hit a year this June on the community fund, or talk about maybe some other new programs. So I'll share about a month ahead of time and invite everyone to join us again. And if you participated today for the first time, welcome.